Hello traders, in this video we are going to talk about Implied Volatility Crush or IV Crush. I get so many questions, what is Implied Volatility Crush, IV Crush, how to recognize it, how to avoid it, and you will even learn that there is an option trading strategy on how we can take advantage of Implied Volatility Crush. Without any further ado, let us go ahead and dive in. Okay, folks, I'm using a very trace apropos example of Implied Volatility Crush because we are in the process of having one tomorrow. This one is Implied Volatility Crush around earnings for MU. So Micron stock just released its earning, and the after hours move is minus 2.3%. It was actually as low as minus 8%. So it has been going through a rally, but that's by itself just plays more into the Implied Volatility Crush. So what is the Implied Volatility Crush? Implied Volatility Crush, you have a sense that, hey, it's a reduction of implied volatility. But by the same token, we know that in order for something to reduce, that something needs to rise in the first place. So meaning the key into having an implied volatility crush scenario, we need to see an implied volatility spike or surge. And this typically happens going into earnings. And the way that you can recognize it, for me, for instance, here, I use the Power E-Trade. There is actually an implied volatility constellation, meaning that they are showing us a historical view of implied volatility. So you and I, we can tell while they are increasing the implied volatility that there is a likelihood of a setup for implied volatility. So when I heard traders usually ask, can I you can avoid implied volatility, obviously, by not trading on something that have overpriced option. So we know implied volatility, as it goes up, the cost of the contract goes up. Yeah. Conversely, if implied volatility come down, the price of the contract tends to come down. So the way that implied volatility impact option is through the increase or the decrease of price as implied volatility goes. So in the case of MU, this is the historical, this is a clean example here of implied volatility crush, really, because we have the historical numbers on here, 66% or in the 68% thereabouts, right? And then for this week, the week of the earnings, so the earnings just took place literally an hour, less than an hour and a half ago. And let's take a look at it. So I can minimize this. We saw the jump on here for this week of earnings versus the other week. So we have that spike in implied volatility. So the crush will be coming tomorrow in the sense that the implied volatility numbers here will be coming down tremendously. So, and actually, some brokers, they actually, no, we were out of the money. So the stock is trading at 55 on here. So you see today, for instance, just for today, because this number here, implied volatility change, reflect just the change in implied volatility today. The 55 call jump, the implied volatility jump plus 45%. They are pretty much in the same range between plus 45% plus 49%. This means that the implied volatility going up, that means the price of all of this contract was inflated just by that. If you have been trading options for a while, I can give you instances, I can remember instances where the stock doesn't move at all and you are making money on option, either on calls, on puts, because of the movement of implied volatility. But let's just take an implied volatility crush. This means that tomorrow, from the moment the market opens, these numbers, the implied volatility will come down, and then implied volatility change will be minus something, minus 60%, minus 70%. That's what I've seen typically on earnings on the stock such as MU. I usually get the question, Telex, when exactly does it happen? Within the first, let's say, it could take as much as 30 minutes, really, depending on what's going on with the price of the stock as well, because market makers, they will be playing on this. Here, this is easy picking for them, right? Market makers on here, folks, it's easy picking because the call definitely will not be making money. But the takeaway for you today here is that implied volatility affect both puts and calls equally. That's really key. So it's not as if, or it's not apt to think, oh, implied volatility only affect the puts, as maybe some traders don't. No, it's, I showed you for the call side. Here's the put side. It's actually went up a little bit more just because the stock was down for the day. So the implied volatility change here, let's say for anything, well, 44% thereabout, is in the same range really, thereabout. Typically on this type of scenario, you will see that this one of the side option of the option puts or call will be a little bit more expensive than the other. We like to take advantage of that in trading. So this sets you up. So as of now, you have learned that implied volatility affect both puts and call. In order for implied volatility crush to take place, we need an implied volatility spike or increase, which we have had actually all week long leading into the earnings. So that's typical of implied volatility pattern leading into earnings. So, but let's bring up a fantastic idea, right? What if we take advantage of the implied volatility spike leading into earnings? Meaning, as we were on Tuesday, Wednesday, the implied volatility was increasing. So this implied, the other question here, as we usually typically have, does implied volatility change every day? Yes, just like the price of the option. Yeah, implied volatility changes every day. You can go on either for a stock that has earning or not. Implied volatility actually, it changes by the minutes here, just that the market is closed. But when the market is open, you will see this number changing here and there. Why will they be changing? Well, the market makers, they have a way. That's just one of the way that for them they make money. So the strategy here that I want to leave you with is the best way to take advantage of implied volatility crush. Definitely avoid buying these contracts leading into earnings, because even if you guess the direction, right? Imagine you bought put today going into this earnings. So 55, let's say you were to buy the 50, even the 54 puts, I guarantee you they're 50 cents in the money. Tomorrow, this contract, they will be nowhere near $1.45 or $1.36. Even though you had the right direction, they will be most likely half of that. Thus, you're going to be losing at least 50% with your contract being in money. Rather, the best thing to do is to track the implied volatility. Let's say you can even, there's a strategy where it's a little bit more expensive. You can start tracking the implied volatility 2 weeks out to the option, meaning 2 weeks ago, you start taking position on MU, and you can really get lucky and make money that way. But it tends to be expensive because the only way to guarantee making money is to take both the puts and the call, right? Because the stock could be moving in either direction. For us, what we like to do here most is on the day of the earning, because implied volatility is moving, we can trade, day trade a given direction. Or better yet, a trader on here, he took advantage of this strategy and he traded both the puts and the call on AMD. And you can see on here, there was simultaneous trade, folks. This contract, the puts, the stock was just down by minus 0.3% or so. So AMD 99 puts on October the 26th led to 100% gain on these puts, and while the calls were making money at the same time. How is that possible? It's through the magic of implied volatility, folks, because the stock wasn't moving that much, but since implied volatility impact both the puts and the call equally, you are able to take advantage of it. So that's the best strategy that I can recommend for you in order to avoid implied volatility crush, which will be taking place tomorrow on here on MU. And we learned that in order for implied volatility crush to take place, we need to see first an implied volatility spike, and we see that through the implied volatility change number on the daily basis. But the implied volatility itself, I mean, anytime that you are buying contract with implied volatility above 100 and something percent, yeah, this number can go as high as they want, right? Let me just give you an example here. Can we go to GME or AMC to see what type of implied volatility we got? I don't even think it's the highest. 400%, folks. Yeah. So here is some implied volatility here of 400%, 500%. So it's not really it's not limited. It doesn't have a fixed range, and it can go as high as you can see. The lowest implied volatility for stock that do not move that much because it just reflects the potential move of the stock, right? Let's see, I can take a stock like maybe Nike. Actually, Comcast is one of those stocks that doesn't, well, Nike has a huge implied volatility here. Folks, let me see here. No, 50%. Okay. So, yeah. And again, the implied volatility depends on the contract, right, on the strike price. So 46% here is not bad, especially for a market that has been this volatile. Let's try to go to CMCSA, Comcast. So typically this stock doesn't move that much, and within for contract at 37%, that's not bad at all. 37-40%, that's actually good. And you see here, because there's no expectation of a big move on the option, so the implied volatility change here for today, at least for this contract that are relatively close to the money, there's not that much jump. Please leave questions, comments, and if you want further examples on there is an article titled How to Beat Implied Volatility in Option Trading on SuccessfulTrading.com. Until then, have a great day or a great evening wherever you are watching from. We bid you adieu. Bye-bye.